Hello and welcome to FidelityConnects. I'm Pamela Ritchie. Much ink has been spilled discussing the end of US exceptionalism. But do the winnings of that so-called trade really end over the period of just a month or two? Today, we're going to dive into the weeds of what works and what doesn't in a concentrated US-focused fund. Happy to say joining us live from Boston today is Portfolio Manager Steve Dufour. Welcome, Steve. Great to see you again. How are you?
Doing well. Thanks for having me, Pamela.
A little warm there?
Quite hot. Quite hot.
Yes. The Eastern Seaboard is, we're feeling the heat. But that's okay. It's summer, so we can't complain about the heat. Let's go into this discussion of US exceptionalism. Your fund obviously is US focused, it's a concentrated fund. Just remind us how the fund is set up again. You talk a lot about the fairway, and then you have some core stocks. How many stocks have you got?
The goal is 36. And I think I may have 37 right now. Yeah. So I try to own 36 stocks with strong relative earnings, trading at attractive prices.
Fantastic. So this term, US exceptionalism, do you feel from your perspective, we're asking lots of people, but has it actually been just a little overdone, the sort of idea that this US exceptionalism trade is a bit over? I mean, it seems like it's gotten to the point where the Uber driver's talking about it, so that's not good.
That's a good point. I don't know the answer to the whether it's over, but the way I look at it, and I run the U.S. focused stock fund, but I also have been working on the Fidelity Worldwide Fund since 2007. So for the last 18 years, I've been looking with my co-partner. Portfolio manager, looking for great ideas around the world. So I don't really ever do anything. We talk about themes, or we talk about anything. I don't do anything at the top level. I really just get down to stocks. As I look at the U.S. stock market, there still are kind of 3, 4, maybe 5 sectors where kind of the U.S. still has an advantage, and it really doesn't change when we change presidents. It doesn't really change year to date. A lot of these things are kind of 3 to 10 year investment cycles in order to have a viable product. So the areas where the U.S. continues to lead, and maybe don't lead as fast, so they may have been one lap ahead, and then they may only be a half a lap ahead, so that could be a little bit of bloom coming off the rose. But in technology, particularly AI, in healthcare, particularly in the development of drugs, in communication services, when you look at like Google and Meta, and then parts of the financial services, whether it's the introduction of new ways to use crypto, stable coins, alternative investments like private equity, private credit, M&A activity. So there's some areas where we're very strong. But having said that, there's areas that are stronger outside the U.S., but they've always been stronger outside the U.S.
Okay, interesting.
The luxury brands in Europe, materials, energy, you can find a lot better names outside the U.S. So I think it's a catchy phrase, but I still think there's areas within the U.S. that are very, very strong.
So tell us a little bit about the fund. I mean, I think all of us have been a little bit holding on for dear life over the last volatile several months. Tell us a bit about the fund.
Well, the fund is a concentrated growth fund, but it's not. It's, as I said earlier, it's strong relative earnings at attractive prices. So I pay roughly 2 more PE points than the S&P 500 average is trading at to get what I believe is going to be substantially better growth or earnings. I follow earnings growth over the next 1, 2, 3 years. And so that has been the process since 2007, as I've been running the U.S. version of this product in 2011, since I'm the Canadian version of this product. But so year to date, the fund has had a tough start to the year, and we haven't changed our process. But what we got hit with at the beginning of this year was, as I say, strong relative earnings at attractive prices. So you went into this year and we thought that earnings were going to grow about 12%. And so you sit there and go, looking for names that are going to grow more than 12% with decent valuation. And we had what I believe was a great portfolio. I still believe it was a great portfolio. But then you get hit with threat of tariffs, Doge, taxes, the fear of higher inflation from the tariffs, and the Federal Reserve not wanting to grow interest rates, even though we're in a kind of an industrial recession in part of the economy, particularly in housing and other parts like that. So it was a perfect storm. So the market started to say, are we going to have 12% earnings growth this year, or are we going to have 2%? And so that's why the market was going like this. And then at one point it went like that, because people got strong belief that the earnings growth rate for this year was heading more towards 2 than it was to 12. And so things that were higher priced got hurt. In addition, we had a number of individual names. So I told you I tried to own 36 stocks.
Sure.
This was a unique period year to date where 5 of my 36 did not perform. 2 of the 5 replaced their CEOs. That's how bad they performed. 2 were from lower spending because of the threat of tariffs and lower consumer spending. 1 was a competitor decided to lower prices to compete against them, which happens. And the other one had part of their business was selling into the construction, ag, and trucking areas, and that area has been hurt the last kind of 12 to 18 months.
So with that, and with I mean, truly exogenous shocks in a lot of ways, the way this stuff came through and hit the markets by surprise, you presumably, what do? You go back to the fundamentals, roll up your sleeves, and you sort of dive back in. What have you been doing in reaction to some of those changes?
Well, the first thing you do is you scrub your 36 stocks. Okay, so let's make a list of all the problems. We now have new variables. So I didn't even throw in the fact that China came out with a very good AI model called DeepSeek.
That was a moment. Yes.
That was a moment. So that brought into question the amount of capex that is needed to do AI. So do we need as many chips? Do we need as many data centers? Do we need as much cooling, electronics? So that was something. So you throw DeepSeek, you throw foreign currency, you throw interest rates, you throw inflation, you throw tariffs, you throw tax rates and where your IP is located. You make the whole list of every problem, and you go back to Doge, government contracting, and you go through the portfolio and say, all right, where are we? What is the effect of earnings if it happens? And what is the problem? And we actually owned a shoe manufacturer who manufactures all of their shoes in areas that were very high tariff. So you go through each of your problems and decide, all right, how confident are we in our earnings projections? What is our ability to predict anymore? Because we try and delude ourselves into believing that we can predict the earnings 2 to 3 years out. If we even can't delude ourselves into that anymore, we've got to go into another name, because you've got to love your stocks. You can't say, you know what, I'm not sure, and stuff like that, because we own very large positions in 36 stocks. So you do that, and that's the fear. So you fear, and then you go to greed. And then the greed is you create a list of stocks that you've always wanted to own in your life. And as I told you, I pay 2-3 points of PE points higher than the market for better growth. That doesn't get you the best in class in a number of industries, because you usually have to pay a lot more than that and to get there. So as I explained to a number of people, I've been talking to people about funds performance year to date over the last few weeks or few months. So I explained that strong relative earnings at attractive prices gets you a beach house, basically 2 blocks from the water. If you go on the second floor of the house into the bathroom and look out the window, you can see the ocean. But there's houses that are 1 block in front of us that are on the ocean. They're usually too expensive. And during this time where things get discombobulated, you got to take the advantage if something comes into your price zone and move closer to the water. And so that is what we did. So we did fear, and then we did greed. And so during this period, we probably added 6, 7 names,
Really?
new names in our 36, which have
That's a lot.
upgraded the portfolio.
Okay.
And yes, because there's a lot of fear, and so you internalize the fear, and then you accept it, and then you use it as an opportunity.
Can I ask, are those names, you often talk about your fairway, where you'll have, maybe smaller positions, and then you'll have some larger ones. Did they all come from that?
Some of these are still a little bit outside the fairway,
okay.
and I usually tell people that we have 85 to 90% of the fund right down the middle. This is what we're doing, but I leave myself a bucket for opportunistic names where you kind of have to look out. Maybe not the 3rd year of earnings, maybe the 4th year of earnings, because these are just very strong franchises in very long runway businesses, and so some of these are still. They didn't come all the way down into our fairway, but they came very close. And I realized that there's something we would definitely want to own over the next 2, 3, 4, 5 years.
Fantastic. So are you quite actually excited about those ones? I mean, have you moved on from some of the ones you obviously had to exit at that point, or they could come back and at some point look interesting again, or this is a new direction?
It's in the end, there's 504 stocks in the S&P 500. And I basically play with 175 of them.
Okay.
There's probably 200-300 names we're just never going to own. It's just not a business. They don't have enough revenue growth. They don't have enough earnings. They have poor balance sheets. Something is wrong with them that we're just not going to do it. So a lot of these names come and go based on what variables are in the market: interest rates, growth rates, inflation rates, you name it, technology cycles and stuff like that. But I'm very excited about the portfolio, because if you follow strong relative earnings, so as I've told you over the years, you and I have been speaking for years, yeah. I don't go out and say, wow, that's a great new theme, I want to put some money in that theme. I follow the earnings and then figure out what theme I now own. So we never got into buying marijuana stocks. We never got into fake meat. We looked at hydrogen. So there's things come and go. 3D printing went like this. A lot. So there's stuff that comes and goes. We follow the earnings. So as we are upgrading the portfolio into stronger earnings growth, we are getting very good themes. A lot of it continues to be in and around AI. There's
Is that right?
various different ways to play AI, but the themes are very strong.
Tell us a little bit about that, because you had the hyperscalers, which led the way, and the money, obviously, but then their valuations ticked down, and then a lot of them have come right back up again. And this is the AI investment. But then you sort of got the so-called, I forget what you called them, the pick and shovel. Yeah, basically the data centers, the places where you're going to get the power and everything else to make it all work. Are you invested in all those areas of that?
Yes, we were a lot more, a year and a half ago, we were a lot more in picks and shovels.
Okay.
Now we're more in operators, and we're trying to get a little bit into implementers. It's hard to do implementers. And then the ultimate goal is to be in products, as well as companies that are doing a very good job of implementing the products. Right. So it's a process that I'm implementing probably over the next 3-5 years. So right now we've still pick and shovels, more operators. So the operators over the last year or so were being used primarily to create large language models, and you've seen all the different ones from Gemini to Grok to ChatGPT. There's a whole bunch of these. There's a whole bunch of these LLMs now, DeepSeek, and what's happening now is people are actually using them, and as they're using them, the data centers are lighting up, and they're basically an ATM machine. So as you're going into your ChatGPT and saying, what is the best way to fix an unclogged drain, or what is the blah, 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 asking questions, or whatever you're asking in the thing, it's lighting up the data center, and then there's cost. They're making money on every query.
Right.
So and so basically they're calling them tokens. So how many tokens did you use to ask the question? How many tokens did it take to produce the answer? And so these data centers are going to become token factories. And so, but that's a good business. We eventually want to own the product that people really use.
Which is calling the plumber, and then however many tokens that costs to unplug the drain.
Yes. Correct.
You got to get to that point. I don't know. The answer to that question for me is always to call someone else, but other people have a different approach to that. Steve, tell us ultimately, with the tokens that you're talking about there, sort of lead me to the question of lots of discussion of stable coins, lots of ideas about money just sort of being data transferring around. I mean, we do it already in many different ways, but getting things kind of priced for that, and stable coins, it looks like, are going to play a much greater role. That's one piece of policy that seems to have some investment dollars around it. Is it one that you're interested in?
Very much so. We've been following cryptocurrencies. Well, stablecoins are kind of a cryptocurrency, but
yeah.
Cryptocurrencies for many years, and looking for ways that are investable. So we own a brokerage firm that 65% of all their customers own some type of cryptocurrency in their accounts, and they're very active traders of cryptocurrencies. We own a cryptocurrency exchange, which is a great business because with the currencies fluctuating, you want to own the trading of it versus the actual currency in a fund like this. And then we've been following stable coins and looking for ways to invest. We also own a trust bank, which does the trust. So they introduced ETFs here in the US, I think less than a year ago, for Bitcoin, and they do the custody for all the 95% of all the Bitcoin ETFs. So wow. It's a growth area, and I think that stablecoins are just getting going. We just had the IPO of the first company, Circle, which was less than 2 weeks old, and so we'll see what where these stable coins evolve into. Some people think it'll stay in the background for transactions. Some people think they'll go all the way to the cash register. So it's easy to debate right now. We just don't know the answer of how far they will. They definitely will be involved for foreign remittance, particularly from countries with high inflation rates. So it's going to be very good for that business. I don't know if you're going to go to Walmart and pay with your stablecoin wallet, but it's not out of the realm of opportunities.
So a couple of different pieces of investment that have had to, in one case, react to policy, which was tariffs, which universally most companies have had to react somehow to that. This is another interesting area of the market that has been brought forth by, as you said, the Genius Act. There's new legislation and rules and regulations around things. There's more to come, it appears, on the regulatory deregulation, basically, story. Also, tax cuts side of things. Are pieces of policy something that you follow very carefully? You're looking at companies, I know, bottoms up, but to what extent are you paying attention to these big? I mean, they could be called themes, couldn't they?
Yeah, no, you're spot on. Not to get into the weeds, but we have the House putting stuff in a bill, and we have the Senate putting things in a bill, and then they got to come together and come up with a big, beautiful bill. But as each of them take things in and put things out, whether it's subsidies for electric vehicles, whether it's funding of solar and wind, I don't really own companies that are implementing solar and wind, but I do own companies that make chips that are used in those processes, and electronics in those processes and stuff like that. So if EVs are going to slow because less subsidies or stuff like this, so I got to watch and listen. But as we talked about tariffs, on, off, these bills, if you listen to them each day, it's hard to trade off of that because the the bid ask between the House and the Senate is so wide, and particularly in areas for healthcare funding and stuff like that. So we don't own, but we have companies that sell products into the healthcare system. So if the funding is going down, so there's a whole host. You can spend your whole day.
Sure.
This is we're only on whatever June 24th, but year to date, it's been a record number of things that have changed or potentially changed.
Right.
That need to be. That we need that, but that's my job, is to make sure the portfolio can weather those changes.
It's fascinating. Is healthcare still of interest with you? As you say, there are movements. I know it's an area that in the past you've been invested and quite interested in. You've always taught me and everyone watching things.
I'm always looking for a good new product. So right now we own 3 healthcare stocks. One is robotic surgery. One does ablation for helping. Well, just a whole bunch of things, but the fastest growing product is ablation. And then we still own one company in the GLP-1 sector. So those are the 3 areas that I think have durable growth. The other areas are under pressure for a number of reasons, particularly for how they do their taxes. They got to watch taxes and then taxes and then taxes, because a lot of the companies in the sector move their intellectual property to lower tax countries like Ireland, and then sold their products into the U.S. in transfer prices at very high prices, creating, in some cases, some are very greedy, tax losses. And so they're cutting, as you talk about following the government policies, they're looking to cut some of these loopholes where people are moving tax dollars around the world. So forget about what product you make, forget about what margins you make, forget about advertising, blah, blah, blah. If your taxes are going from 0 to 24, that takes up a lot of 24%. That takes up a lot of your earnings, and probably 2.5 years of earnings growth. So there's a lot of minefield. The long and short of the whole thing, there's a lot of mines in the minefield this year,
right, okay.
and you've got to step carefully, because right when you think you found something that's safe, something is changing. So that's why you just got to watch these names day to day.
Nimble, yeah, got to say nimble, and you have a concentrated portfolio, so you're making choices. Can you comment, Steve, on your stock selection of the Mag 7 names? For instance, why less weighting to some, if any, more to others? Can you just kind of go through? They do different things, but they get lumped together, don't they? Yeah.
Yep. So this is where we get a little tricky, because they like me to stay in my top 10. So,
okay.
But Meta is so this. So, but let's think of AI. So almost all of them are AI driven. And so as we look at AI and you play out the scenario, and I reserve the right to change, but you want to have very good distribution. You have a good product with great distribution, and defendable against competition. Okay, so as I look at my largest position, which is Meta, they have great distribution through their various properties, which touch 2.3 billion of people on the planet, all who have purchasing power, and they've been doing advertising to them. But as they add new products, they have the ability to take a new product which they're developing and put it on their system, as well as go into new services like search, Google search, and stuff like that. So that is a company that has new products going into great distribution. That one is a no. Amazon, 2 businesses, but they have a great web services business, which allows them to be in the forefront of distributing as well as implementing new products. So that's 2 for 2. NVIDIA, until things change, is the best way to implement AI processing power quickly. Everyone says they're going to eventually be a competitor, and blah, blah, blah. And they're right. So if you go out long enough, there's going to be a very strong competitor someday. But right now, they're making billions and billions of dollars at 85% margins. So that is a name I don't think you can bet against. You have to watch it because it is the chip industry. So there's 3 for 3. Outside of the top 10, you need to look at some of those names about what they're doing and talking about. Some are talking about future products that may or may not evolve into big things. Mm-hmm. Others have decent distribution but no product. Others are the strongest leader in a product, the best product that was ever created on the planet with 99% margins, but now has infinite new competition. So let's think about whether you want to own a company which margins look like they can go one way and you have infinite competition. So I'm not talking about all of them, but that's the way I would frame it. I'm looking for helpful. Product and distribution, and I'm trying to avoid companies whose existing product is coming under duress. I mean, so just ask. Yeah.
That's super helpful. I wanted to try and get 2 questions in. So this is the penultimate one because it's a U.S.-focused fund, of course, but you do have the ability to go outside the U.S. So this is essentially a question on taking a look at your allocation outside of the U.S. What can you do? What have you done? Just give us a quick update on that, and then I got another one for you.
The majority of that is in the great country of Canada.
Yay! Okay, anyway, sorry, I didn't do that. Yes. Is it really? That's interesting.
Yes.
Is that commodities play broadly?
One of them is commodities play, which I could talk about because we've talked about before in things.
We don't have time.
It's a royalty trust. It's a royalty trust company.
Okay, got it. Yeah, perfect. And then let's just kind of swing back to this idea of having you walk us through the US-exceptionalism, story, because I think it gets a lot of press, as we said at the beginning. But at the end of the day, they're just incredible companies, and you have a very laser focus on some of these within your fund. So just kind of wrap us up with the story of where this fund belongs, perhaps for Canadians that are taking a look or are already invested.
Yeah. So if you believe that AI, e-commerce, electrification, innovative healthcare products are some of the fastest growing areas, which I do. Those opportunities, as well as some new innovative payment systems, the best way to invest in those are in companies that are in the United States. Not saying that that means US exceptionalism. I'm just saying I just need 36 stocks. And so as I look around the world, I see the best growth and attractive prices in areas that currently are in the U.S. And so that's why I'm still very bullish on the U.S.
It's great to see you and catch up with you, Steve Dufour. You've been busy. You're always busy, but it's great to sort of just have a moment to hear what you've been up to. All the very best for the summer.
All right. You too, Pamela.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.